Risk of material misstatement: the risk that the financial statements are materially misstated prior to audit. We have the overview of checklists depicting combined risk, average inherent risk and average control risk scores based on the responses under each topics. Let us dive into inherent risk. It refers to the chance that something in the financial statements could be misstated, just because of the nature of the business or the type of transactions, underscore even before looking at any internal controls. First comes the understanding client business, under which the business details, other details, and the related parties assessment can be completed. The next is significant risk assessment, which will have questions and responses to be selected from the drop-down against each questions. The next and the final one is SA 250, consideration of laws and regulations in an audit, which has the particulars pre-filled in the software and the discrepancies against each particulars that has to be noted. After identifying inherent risks, the next step is to assess how well the client's internal controls are designed, and whether we can rely on them to prevent or detect material misstatements. The control risks are categorized into 4 key areas. Times entity-level risks as per the COSO framework will have the risks described and the respective responses, assessment scores, and nature of risks under various heads like control environment, risk assessment, information system and communications, monitoring of control component. Times fraud-related risks, which will have the risks described and the respective responses, assessment scores, and nature of risks under various heads like generic, incentives, pressure, opportunities, attitudes, rationalization, and misappropriation of assets. Times process-specific risks is the feature which deals with identifying the process and mapping the relevant accounts, thereby enabling the users to perform the test of controls accordingly. Times management inquiries record responses from management on controls, risks, and fraud. Supports auditor judgment and risk evaluation. Under the management inquiries assessment, you will see a set of questions with yes or no responses in the drop-down against each questions. Once you give the responses, the system will save the responses for the purpose of evaluating the risks. Once the risk assessment is completed, we move on to audit planning, determining materiality. Once the risk assessment is completed, we move on to one of the most foundational steps in audit planning, determining materiality. This could be found at the end of the risk of material misstatement screen. The purpose here is to comply with SA 320 by establishing materiality thresholds that are tailored to the entity's financial profile and risk characteristics. Materiality helps us determine what matters most in the context of the financial statements and guides our audit strategy, including risk assessment, scoping, and the nature, timing, and extent of audit procedures. The activity begins by reviewing the platform's system-suggested materiality figures, which are auto-calculated based on the entity's orientation set and its risk profile. You also have an option to record the previous period materiality by clicking on Record and entering the details such as basis name, planning materiality, performance materiality, and the trivial balance. You can then add one or more relevant bases for materiality. While adding a base, the figures are auto-fetched directly from the trial balance, and the cursor is placed on the recommended materiality level. The high, medium, and low materiality percentages follow ICAI's guidance by default. However, if needed, you can select the custom option and input your preferred materiality percentage, at which point, the platform will automatically compute the corresponding figure. Similarly, you can define your performance materiality and trivial misstatement levels. Once all applicable bases are added, you can then select the most appropriate one, such as revenue, total assets, or profit before tax, depending on the nature, size, and industry of the entity. If there are significant developments during the audit, such as major adjustments or a shift in audit focus, the selected materiality base can be modified in accordance with SA 320, provided that a valid audit rationale is documented for the change. Throughout this process, the platform ensures that any updates to overall materiality are automatically reflected down to the account balance level, maintaining alignment across the audit file. As a result, we arrive at a well-reasoned, dynamic, and audit-specific materiality structure, one that complies with SA 320 and supports effective scoping, sharper risk responses, and efficient audit execution.